Welcome to It's the Economy. The Ministry of Statistics, or MOSPI, will announce the first advance estimates of this year's GDP. A CNBC TV18 poll expects the MOSPI to announce a 7.5% real GDP growth for the current year, and more importantly, only an 8.3% growth in nominal GDP. That is GDP unadjusted for price rise. This nominal GDP number will become the base for the February 1st budget. To get more on what to glean from the GDP numbers, today I have with me two top economists, Upasana Chachra, Chief India Economist at Morgan Stanley, and Sakshi Gupta, Vice President and Senior Economist at HDFC Bank. Ladies, thank you very much indeed for your time. Upasana, first, will nominal GDP the most important number to watch out for, and what are your expectations?
Hi, Latha. So for nominal GDP for fiscal 26, we are at 8.4%, so not very different from your poll. And on real GDP, we are a little bit higher at 7.6 for fiscal 26.
Okay. Would that be the most important thing to watch out for, nominal GDP?
Yes, I think in this environment of low inflation that we have seen, especially in the last 3 quarters, where the nominal growth has been moderating while real growth has been showing a robust trend, the nominal growth will be an important key takeaway that we will have. Also in context of, other derivatives that come through it in terms of fiscal deficit and implications for that with the upcoming budget as well, in terms of, how large is the base for the nominal growth that we can assume for the next year.
Okay. Sakshi, good morning and welcome to you as well. What would you watch out for in today's numbers?
Good morning, Latha. Happy New Year. Yeah, I mean, as you rightly said, look, these the numbers that we will have today. This is the advanced release. This is basically an extrapolation of the trends that we have seen in data up till November, right? So, in terms of drawing broader conclusions, especially at the sectoral level, for FY26, I think this number will essentially tell us what was happening in the economy up till November, right? And we know that a lot of the high frequency indicators till then, because of this, festive season demand, etc., were kind of holding up.
Yep.
Our estimates for real GDP growth is 7.4, but honestly, the risk to this forecast for me is clearly on the upside. So I won't be surprised if the number is much higher than this. As you rightly said, I mean, the most important relevance for these estimates is actually its implications for the fiscal calculation and the upcoming budget, estimates. On the nominal front, we are estimating, a number close to what your poll showed up, 8.3% growth in nominal numbers. I don't think that, if we get a number close to this, figure, that it really upsets the fiscal math for this year. I think what will be interesting to watch out for, and this will have implications for next year's estimates, what is the government going to assume, in terms of nominal growth for FY27, we are expecting 10.1, right? And that has implications for what they assume on tax collections, on debt to GDP, etc. So I think the most important figure in this release, as you rightly pointed out, is really the nominal growth assumptions that the budget will work with.
Okay. Well, Upasana, we've got some advance data over the past 4 months or 3 months. We just had a note from Elara, which is speaking about very strong auto growth in the September-December 4 months, that is post GST cuts, compared to the previous 4 months and the year ago 4 months. I mean, very strong auto sales data, and that's usually a very good lead indicator. So should we be prepared for even bigger upsides than 7.6? By the way, Upasana, at 7.6, you're among the highest.
You're very right, Latha. The high frequency data that we've got in the last couple of months, and especially I think, sectors which have got positively impacted with the GST tax cuts, has been very strong. So auto sales across passenger or two-wheeler sales have held up in the double digit, almost 20% plus sort of a growth rate if you were to average the last 3 to 4 months. That is very strong numbers. And I think if we were to further dissect it, like, festive to festive, which was very strong at 25% plus. But post-festive also these numbers are holding up, which is an important indicator to see whether this growth trend can actually continue to maintain its pace, or whether it sort of starts to fade out. So that is good news, because data up until December is holding up. And
Upasana, 1 minute. While I picked up the best fruit I could get, which was the auto sales number. But if you look at power consumption, that's been pathetic. Real estate sales, I saw some number of minus 17% for certain regions. Therefore, can Q3 be, still be a kind of dicey quarter to predict, and more so Q4? Are you reasonably convinced that the GST sales consumption, GST cut boosted sales will continue in Q4 as well? Are you getting that sense about consumption?
Right. So I think for Q3 or December quarter, I think over there is less of a risk of any, the numbers being lower than anticipated because of the GST impact. And you're right, power demand, there are certain pockets which have not done as well. But again, if you look at even power, that is now improving. So December is a plus 6% growth versus, yes, last few months, which were weak. Credit growth is picking up quite nicely. And so are, things like credit card spends as well. So there are certain broader indicators which are showing signs of strength. Q4 or March quarter, we would expect a deceleration, but that is linked to the base effect. And that would start to play out. So in our assumption, Q4 numbers would be lower than 7%. We are at about 6.8 on this base of GDP right now.
Okay. Anything else we should watch out for, Sakshi? Don't we often look for the private final consumption expenditure and the gross fixed capital formation numbers? Our poll threw up a number of 7.5% for consumption. You think that's a fair assumption, or would it be better?
Right. So a couple of points, Latha. So first, to your question on consumption and investment, look, we've had very strong numbers in H1, right? Both for investment and consumption. So, for the whole year, I think that given the recent momentum from high frequency indicators, I do anticipate that both for consumption and investment for the whole year, you should end up with a 7+ number. So for investment, for instance, we are projecting 7.5% for FY26. And for consumption, we are close to 7.2. But a lot of this is being driven by, on the investment side, because you had a lot of front loading of expenditure by the government in H1. So numbers were very strong. And then for consumption, I think the GST cuts, low inflation, etc., all these factors are playing out. Just one point I want to make to your earlier question, on the fact that some of the data, while yes, on the consumption side, things seem to be picking up and the momentum is holding on, but all the macro data that you look, everything is not positive, right? And one of the things that I am closely watching or concerned about is the impact from government spending, right? So as we move into Q4, if the government has to kind of meet its FY26, fiscal targets, I do expect some amount of expenditure rationalization to happen. And I think some amount of that will actually fall in the fourth quarter. So, I would be a little, I'm not completely, overtly optimistic about Q4 numbers where, there is still some amount of uncertainty as to how much the growth momentum is going to be.
You want to add to that, Upasana? I think in your note, you also point out that we may have lower public expenditure because, for the second half, the base also becomes high. And there was a lot of front loading of both government capex and exports. So possible downside surprises?
So, I think as I mentioned, the Q4 number will see a moderation because of base effect. So we are building that part in. From a government spending perspective, this year is exactly like the opposite of last year, where the first up to November spending, especially capex, was so weak. And then there was a big sharp pickup in the last 4-5 months. And this year, as Sakshi has also pointed out, we are of the same view that it's not an easy year to meet fiscal deficit target as well, like we've been used to in the last few years because of tax buoyancy. So tax collections are running short of budgeted estimates. And in our view, the government will meet 4.4% of GDP, the fiscal deficit target. And therefore, to meet that, there will be a need to crash rationalize expenditure. So the impulse from public spending will be weaker, and especially I think in the last quarter. But some of it is getting built in these numbers, which are reflecting a moderation from December to March.
Okay, last 1 minute. So please, each of you take only half a minute for this question. Sakshi, how important is this very poor nominal GDP that we are seeing? Can we assume a better nominal GDP for next year? Will it be low nominal and therefore low tax collections?
So you're absolutely right. I think nominal GDP growth numbers very important. Below 9% nominal GDP growth doesn't bode well for a lot of indicators, including things like credit growth. I think for next year, what might work well for us that even with a real GDP growth between 6.5% to 7%, inflation will start picking up because there is a very low base. So we are expecting nominal GDP growth to be somewhere around 10.1.
Oh. Okay, that's positive. Upasana, your nominal GDP expectation and worries?
So numbers similar to Sakshi, we do expect nominal GDP in fiscal 27 to revert to the 10% mark.
Okay.
I think, though, to your question, it's a very important indicator from a corporate revenue and corporate earnings perspective. We do think this low inflation environment will start turning. Probably December quarter should mark the trough from a nominal growth perspective, and the next 4 quarters should start showing mild recovery.
Okay. Well, I did want to ask you all about how all these numbers will pale into insignificance on February 28 when we get a new series. Okay, very quickly, I believe we have time. Sakshi, you think all these numbers will look very, very different on Feb 28? Or will they look better?
Right. I mean, honestly, it's speculation at this stage. But yes, of course, as I initially said, I reserve my, drawing broader conclusions from this data right now because we are waiting because there's a series change, there are changes in methodology.
No, will it be better or worse? What's your sense?
Well, I hope it's going to be better. But this is
hope is not a data point.
Yes.
Upasana, expect it to be better when the new series comes?
I think if we go with the last pace revision, where we saw massive upward surprises in the new GDP series, just anchored on that, I think it could be better.
Okay. But you know what? It gave us a very poor FY14 number. It was a 5.3 or something. Yes. So it can cut both ways. Thank you very much, Upasana and Sakshi, for telling us what we should watch out for this evening when the numbers come. Well, that's it on this edition of It's the Economy. Time for a break. Chartbusters up next.